Next on the agenda is a keynote address. The keynote address today is going to be done by Damali Ssali. By way of introduction, Damali Ssali is a senior chartered accountant. She is a trade development expert. She is a lover of coffee and Uganda. Ladies and gentlemen, put your hands together for Damali Ssali.
Ladies and gentlemen, thank you. I am so happy to be here, and Nicholas and Innocent, thank you so much for the introduction. I will be talking about how Africa can achieve full financial inclusion by leveraging digital technology. But before I get into it, I would like to take a moment to appreciate, to recognize, and to give special thanks to High People and its CEO, Innocent Kawoya, for being persistent and consistent in supporting digital inclusion and financial inclusion year after year, every single year. So I think they need special recognition for that. By extension, I also want to thank the partners of High People who have been mentioned before: Moja Loop Foundation, the Gates Foundation, Modas Box, the Level 1 Project, and the United Nations Capital Development Fund. In my submission, I'm going to give a synopsis of the state of financial inclusion on the African continent as it stands for now. I'll also explain why financial inclusion is critical to the socio-economic development of Africa, and I'll give a few recommendations. Over the last decade, Africa has had some of the world's fastest growing economies, with GDP growth rates averaging about 5%. That was until 2019. Recently, in 2020, Bloomberg has issued a report that indicated 7 out of the 10 fastest growing economies in the world are in Africa. That is Uganda, Ethiopia, Ivory Coast, Egypt, Rwanda, Ghana, and Kenya. However, economic growth can only be socially sustainable if that economic growth is inclusive. And one of the main components of inclusive, sustainable economic growth is financial inclusion. Unfortunately, financial inclusion is one of those areas that the African continent is lagging behind other continents. On average, less than 25% of African adults have access to a bank account through a formal financial institution. Over 80% of these adults say that the reason why they don't have a bank account is that the cost of having one is too high, the distance to the formal institution is too far, and the documentary requirements to get one are too stringent. Next slide, please. Similarly, evidence shows that 45% of all businesses in Africa are more likely to lack access to bank credit, regardless of size. Obviously, the financing constraint is much more acute for micro, small, and medium-sized enterprises. And this is very, very unfortunate, because evidence also shows that micro, small, and medium-sized enterprises are the majority providers of jobs. Over 66% of all jobs in developing economies are through micro, small, and medium-sized enterprises. In Africa alone, we have more than 50 million micro, small, and medium-sized enterprises, 70% of which are in the informal sector. These businesses contribute over 33% of Africa's gross domestic product, making them critical to the socio-economic development of the whole continent. However, only 29% of formal small and medium-sized enterprises have access to a loan, have access to a line of credit, or have access to an overdraft facilities. The value of this credit gap for formal SMEs in Africa is over $100 billion, out of which 90 billion is to SMEs in sub-Saharan Africa alone. Financial inclusion, the importance of financial inclusion on the African continent cannot be overstated. Whenever a society or a population achieves financial inclusion, it is able to mobilize higher household savings, it is able to increase the number of entrepreneurs in that population, and it enables the people in that population to invest in themselves and invest in their family. Also, quite important, is that it enables the government of that population to have a lower burden in supporting or providing public goods and services to the population. The good news is that the number of women entering the workforce in Africa has been increasing steadily, and so have the number of women-owned businesses. According to the World Bank survey, about 30% of all businesses in Africa are owned by women, although women still face significant financial constraints to participate in the economy. This is despite the fact that the International Monetary Fund has reported that an inclusive economy can increase its gross domestic product by 35%, of which 7% is purely based on productivity. So I have a few recommendations for you, most of which have been made by a lot of the panelists here, but just 3. The first one is on the regulatory framework. Several African countries are still missing regulatory frameworks to guide financial inclusion and digital financial inclusion, for that matter. And those that do, the regulations are so stringent around the know your customer requirements that govern digital financial services. So my recommendation is that there is a need to review the regulatory frameworks so that they enhance rather than curtail financial inclusion. Second recommendation is around interoperability. A global payment system survey conducted by the World Bank indicated that only 20% of digital financial solutions available were either partially or fully interoperable. This limits the attractiveness of technology-based solutions to customers and leads to low usage. I therefore recommend that the providers of digital solutions develop solutions that are based on level 1 principles, one of which is interoperability. And it has been discussed extensively by one of the panels. The last recommendation is that government should digitize its services. In any country, the government is the largest provider of goods and services, and therefore the largest provider of financial services. Governments on the continent need to start embracing digital technology in the provision of services to all people, but especially to poor people, to vulnerable people, and to women. So my final recommendation is that the governments need to develop infrastructure backbones that support the digitization of financial services in a manner that is inclusive. With those few words, ladies and gentlemen, thank you so much.